Good morning and welcome to the AFENTRA PLC investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Paul McDade, CEO. Good morning to you, sir.
Thank you. Welcome, everyone, and thanks for taking the time to join us this morning. I'm joined here this morning by Anastasia Delina, our CFO, and Ian Cloak, our Chief Operating Officer, and both Anastasia and Ian will be joining me to make the presentation. Just say that the purpose of this morning's presentation is to do a number of things. To summarise what we have achieved since we founded AFENTRA in May 21, 3 years ago, to demonstrate that the company remains in a strong financial position despite having just completed 3 acquisitions, explain why we are so excited about the future value creation potential of both 305 and 305A assets, and why we think AFENTRA can continue on the journey to pursue value-driven growth in Angola and beyond Angola across West Africa. The next slide is a disclaimer, so you can read that at your leisure. Moving on, when we founded AFENTRA in 2021, it was considered a bit counter-cyclical, given we were at peak ESG at that time. However, we had a clear vision for AFENTRA, and we had a clear view that we could create value by focusing on a number of things. We focused on the African continent. Why? Because we believed at that time that Africa would continue to develop their resources and would demand fair access to their oil and gas resources in the global market. I think that has now developed into what people refer to as a just transition. We focused on ensuring ESG was central to all of our activities. This is just as important today as it was in 2021, despite there being a more pragmatic view from many of our stakeholders around ESG and climate and what the balance between social and climate impact is. We were very clear we were pursuing production and development assets that were non-core to both the IOCs and NOCs. And by focusing on Africa, we were building on our long-standing relationships and reputation in the continent. The final point that will come through in the presentation is we have a way of working whereby we work closely with local companies and work together with the local companies to assist and develop their capabilities and skills rather than being seen as a competitor. And I think that has been given us some success within Angola, which is where our focus will be today. Our pursuit of this value-driven growth strategy has been successful to date, as demonstrated by our share price performance. We started the company at 15p and we're trading around 60p today. But I would like to acknowledge the very strong support we've had from our shareholders throughout the journey, despite delays to completing the 3 acquisitions we'll talk about today. Very much appreciated that support. And I also think that shareholders have appreciated the alignment management has with them by being personally invested in the company. I'd just like to go on and say a few general things around Angola before handing on to Anastasia to start focusing in on the financial aspects of the company. Many of you may not be familiar with Angola, so what I'm trying to do here in this slide is make a comparison with the UK continental shelf, which many of you may be more familiar with. If we look at the last 30 years in the UK continental shelf, back in '93, production in the UK was around almost 2 million barrels a day, just less. They had 25 billion of reserves and resources to be produced, and it was dominated by the major IOC companies. In the intervening period, we've seen a huge industrial transition in the basins with many, many transactions. We think the value of those transactions is probably somewhere around $50 billion. And now the UKCS is dominated by independents, not IOCs. There's been a significantly improved recovery, extension of the assets' lives, increased reserves and resources, and significant value creation for many, many shareholders and stakeholders. If we look and make the comparison with Angola, where is Angola today? In 2023, Angola was producing 1.1 million barrels, previously having been at 1.8 million barrels. So there's been decline. They're looking to reverse that decline. Why? Because they have 15 billion barrels of reserves and resources discovered and yet to be produced. And the majority of that reserve and resource is held by the international IOCs, or Sonangol, the national oil company. We believe there will be a transition over the coming decade and more of those assets changing hands in the same way that happened in the UK continental shelf. I think the other very positive thing is at the moment in Angola, we have a very positive investment environment. The government has brought in many reforms. They've created the regulatory authority, ANPG, who we've been working with closely. The oil and gas industry is core to the Angolan economy, so therefore it's fundamental that they continue to produce oil and gas for the economic social development of the country. And what the ANPG have been doing with the support of government is actually improving the fiscal environment to make it a competitive environment and to encourage investment. And I'm pleased that actually what they have seen from that hard work is an increase in a step up in the investment that's occurring offshore and onshore in Angola. There's abundant resources in the country, and we believe there'll be an opportunity pipeline as we proceed through the next decade. So the opportunity of AFENTRA is an early mover and an early entrant. One of the few independent oil and gas companies working in Angola is to take advantage of that position, and we expect, as I'll talk later, to be doing more in Angola than we have already done. But with that summary, let me hand over to Anastasia, who'd walk you through some of the financial aspects of the company at the moment.
Thank you very much, Paul, and good morning to everyone. Thank you for listening to the story of our journey. Paul has wonderfully set the stage for me to talk about the financial framework of AFENTRA and how we balance risk and reward on the finance side of things. First of all, let me tell you about the value evolution since our inception in May 2021. So 3 years ago, we started off with $14 million of cash on balance sheet. We had a very small group of employees, and early on, we knew that we do not have to go back to the capital markets to raise financing to support our G&A budget. Fast forward 3 years from that date, we have an asset base which comes with a NAV of over $250 million. And we think that number will actually improve. And we are focused on discussing and presenting to you our asset base, which Ian will talk about later on. In the last 3 years, we have received a little over $150 million of financing proceeds and cash flow contributions from the asset. We have spent $176 million on deal completion and asset and corporate costs. And at the end of May, we have $14.6 million of cash on our balance sheet, unrestricted, and we have $46 million of net debt. Very importantly, that number does not include the crude oil stock of 840,000 barrels, which we plan to sell in June, with the proceeds coming in July. What do we pride ourselves on the finance and commercial side of our business? There's a few points to highlight on the right-hand side of the slide. First of all, we have proven business development capabilities. Individually and collectively as AFENTRA, we have decades of experience in the markets where we operate, and that allows us to analyze deals and sculpt transactions that lead to value creation, which we will talk about on the next slide. Number two, we have years of experience in the capital markets network. We, as individuals, have been known in the financial sector for a very long time. And as a reminder, when AFENTRA was only a £32 million company, we raised combined financing in excess of $140 million. Thirdly, we largely keep expertise in-house. We have commercial, M&A, and legal expertise in-house, and that allows us to do deals efficiently and cost-effectively. And the final point is the deal numbers. We have a robust management system in place that allows us to plan ahead. Now, let me talk about the 3 deals combined on slide 6. This is a fascinating page which brings all the numbers together. I'm sure you have seen individual transactions in the past, but here we bring it all together. The upfront consideration for all 3 transactions was $117 million. With the passage of time, when we completed all 3 transactions, we ultimately only paid $76.5 million. And this is a result of all the cash flow contribution from the assets from the effective date to the time when those deals were completed. This actually gets better because not only we only paid $76 million for the deals, we also inherited close to 850,000 barrels of crude oil stock, which we ultimately monetized in the case of INA and Sonangol, and we're yet to monetize the barrels from the Azul transaction. If you were to add up all the proceeds from those entitlement barrels, we will realize close to $68 million. So the combined result of all 3 transactions together is $9 million paid for all 3 deals combined. We do have contingent payments to make, and we have details of them on the right-hand side of the page. If we were to make those contingent payments, it means that commodity prices are strong and operationally these assets perform very well. What this allowed us to do is effectively complete transactions that not only were good for AFENTRA, but also allowed the sellers to realize value from the assets in the future. Let's talk about financial outlook on slide 7. We have released those results just over a week ago. And as you can see, obviously, everything is looking very positive for 2023. We can only assure you that results should be better in 2024. In 2023, we only produced 3.6 thousand barrels a day. That number will improve to over 6.5 thousand barrels this year. Our revenue came up at $26.4 million. Again, this was just for one lifting in August, where we'll have more than one lifting, obviously, in 2024. We'll talk about it later on. Our EBITDAX was $11.1 million. Again, this is just based on the revenue generated from one single lifting. And we view that number particularly favorably when you look at the EBITDAX to net debt ratio, which stood at 1.1 times. Again, we plan to improve on it in 2024. Our net loss has gone down to $2.7 million from $9.1, and net cash from operations, which is pre-capex, pre-G&A, and pre-financing, but after Angola tax, was $12.3 million. Again, you should anticipate we improve on it this year. Overall, we had a very strong year, and if everything stays on track, we should be approaching a net debt to zero position by year end. There's one more detail we included on this page, which is around our debt profile. We have drawn a combined total of $47.3 million on our RBL at the end of May 2024. The cost of that facility is SOFR plus 8%, which works up to be around 13% at the moment. And our annual repayment plan is $10.5 million for the following 4 years. We have already made one prepayment this year, and we have a balance of $5.3 million to pay in 2024. Overall, a very healthy picture. We have no concerns around our ability to service our debt. And as I said, 2024 is so far shaping up to be a very good year. Now, turning to the offtake and the hedging strategy, we have received a number of questions with regards to our lifting and hedging. So we'll talk a bit more about that, and hopefully that will address some of the questions that came in. So first of all, let me talk about the actual logistics of liftings. Every partner in the block has an allocation of production proportionate to the ownership. With the current full cost recovery pool and an active investment campaign, partners get allocation of around 85% of all crude produced. In the case of AFENTRA, we get approximately 1.9 million barrels of crude in 2024 to lift. Every cargo is approximately 985,000 barrels. So if we were to sell a full cargo, we can only sell 2 cargoes a year. The crude is lifted from the Palanca terminal, which serves the Block 305 and the Block 305A, but also JV partners producing from the adjacent Block 205. A JV partner that has the highest number of barrels to be lifted goes first in the queue. So again, in our case, in the case of AFENTRA, if we were to lift a full cargo, we would only go up in the queue twice a year. Even though we have a working capital facility to bridge us between liftings, we have chosen to be proactive about our lifting strategy. And what we have done in the past is we partnered with Morel and Prom, our second largest JV partner in Block 305, and we jointly lifted crude in August and February, and we have an upcoming lifting again with Morel and Prom in June. We are working actively with Morel and Prom, along with other JV partners, to optimize our future liftings. And we look at an August lifting of somewhere in the 600 to 800 range, and we also are looking at the year-end or early 2025 lifting of somewhere around 400,000 to 500,000 barrels. With regards to hedging, our board policy is to hedge in the range of 50 to 70% of the next 12 months cargoes and between 30 and 50% of the subsequent 12 months. To date, we have placed hedges for our February production, where we bought puts at $70 a barrel, and we have also recently hedged our June lifting, again at 70%. In that case, we bought puts at $80 a barrel. We will continue to proactively analyze our hedging policy, and we will look to update the market when we have updates with regards to our future hedging plans. Briefly on the prepayment facility, this facility is with the Mauritius Commercial Bank. We have up to 30 million facility, and we pay SOFR plus 4.75. It gets repaid to zero at the time of each lifting. And in the past, we have borrowed for anywhere between 2 to 4 months to bridge us between the liftings. Finally, let me talk about, before Ian discusses really exciting things with the asset, I'll wrap it up with the framework of how, again, we think about the financial and risk management in the finance. Number one, the liquidity management. It's very important. We are still a very small cap company, but we plan ahead. We run multiple cash flow scenarios. We actively manage our lifting programs, as we just discussed, and we also watch our spendings. Number two, we risk manage. We have a very strong governance framework in place, led by our board, who collectively have been through all the ups and downs of the oil industry for the best part of the 40 years. We have a robust hedging strategy, and we're also proactively managing our relationships in country, which has been proven critical. And as you have seen, we've been able to complete those transactions, even though it has taken a little bit of time, we were still able to complete them on the terms that have been very attractive. Number three is our capital structure. The key element here is flexibility. Should better financing opportunities present themselves, or we have to raise debt financing for another transaction, we can always choose to take out the existing facility without any penalties. The choice is ours. Finally, and I already walked you through the numbers, what we have achieved is quite remarkable in the last 3 years, and we pride ourselves on our deal creativity, and we hope to demonstrate to you again that we can do it again. Thank you very much, and I'll turn it over to Ian.
Well, good morning, everyone, and thank you for joining in. Before I talk through the slide on the asset, I thought I'd just step back and just describe what differentiates the AFENTRA operations in subsurface from others. And you can read in the annual report about the values, but I think that there's probably 3 or 4 key elements that I think also distinguishes us. First, a proven pedigree in Africa, but also applying experience globally. The team has decades of experience, operated non-op, We know what works, and importantly, we also know what doesn't. And when we're looking from a business development perspective, there's little the team has not seen or worked on. Secondly, the skill sets, it's diverse and complementary from differing companies, so we can apply best practice from both Africa and worldwide. The third one is relationships and soft skills, often underplayed, but when you're working as a non-operator, absolutely critical working in a joint venture, and allows AFENTRA to play an outsized role in collaborating with both the operator and the JV to make sure that we're optimizing the values. And then what that also does is brings other opportunities as a partner of choice. The last one is impact. And when I talk about impact, it's constantly asking how we make a difference, whether it's as a local partner, emissions profile of the asset, to social investments in the host country. So we'll move on now to the asset. And this slide summarizes it up in a number of key points. Start off with scale. I mean, by any sense, this is a giant asset. It covers an area from one side of the M25 to the other, to those in the London area. From a volume perspective, if you were to look at this in the North Sea context, this would have been in the top 5 fields in the North Sea. Oil in place is 3.5 billion barrels with 42% recovery to date, but we're targeting over 50%. So there is an opportunity here to double the 2P, and that comes from a variety of opportunities, from low-cost workovers to infill to developing discoveries to near-field wildcats. And then if we look at the recovery factor for Block 305A, that is currently at 1%, and we're targeting 30% on that. The second element of the asset is the infrastructure, which is in place, and this allows us to redevelop what is a midlife asset. And it allows us to be much more effective to reuse infrastructure rather than build it new. Historical numbers on this asset, they point to a giant 200,000 barrels a day at peak, 300,000 barrels of water injected in the ground, initially developed by Elf Total and then more recently by Sonangol since 2000s. From an emissions perspective, this asset does have relatively high emissions, but I think the key thing we had identified back in 2021 when we took it on, but there is a way to reduce this to zero, and we'll talk about this a little bit later. So the takeaway here, it's a vast undeveloped asset which could allow reserves replacement via different options while also reducing emissions. So moving on to the next slide, and this is a key slide on the future production profile for both Block 305 and 305A. 4 key building blocks, dark blue, lighter blue, and then the lightest at the top. The types of work we do, the darker blue are stabilizing and sustained production. We'll talk about in the next slide. Optimization of wells and infrastructure, infill drilling, the next wedge, and then development. The development of the satellite discoveries. And this requires a lot of collaboration with the operator and JV, something I just discussed in the last slide. The deals we performed, INA, Sonangol, and Azul, effectively restructured the partner group, giving 3 big players, Sonangol, ourselves, and M&P, really the controlling elements to drive the asset redevelopment. And I guess the key message on this slide, there's a lot of opportunities, but it's focusing on the right ones to leverage the value while we also reduce the emissions. So the first one I'll talk about is stabilizing and sustaining production. On the left, you've got the work scope in action. It's a production profile of both 305 and 305A from 2023 to April this year, growing from 17,000 barrels a day to 23,000. So how did we achieve that? And in the middle, you've got field management, water injection, well works, and emissions. Field management increased up to 87% the uptime last year. We're targeting 90% in 2025. In January, for a month, we had 94%. Asset revamping is going to be key here as we plan for the next 20 years. And some of that is shown as the life extension of $8 a barrel. What is it? It's upgrades of power, water, pumps, all the investments that are required to drive this asset for another 20 years, which are unlocked by the new fiscal terms and the extension. Water injection is the next box. That's our cheapest barrels. Last year, we doubled it to 33,000. We're aiming to double it again to over 60,000 in 2024. We need to double it again, and we're targeting over 150,000 barrels a day. For each 1% increase in recovery factor, that increases about 30 million barrels of recoverable. It's also the quickest way to reduce flaring. As we inject more white water, we raise the reservoir pressure, which lowers the GOR, the gas oil ratio, which in turn lowers the flaring, lowering the emissions. The next box is the light well interventions. 75 are targeted from 23 to 24. We delivered 30 in 23, looking at 45 this year. Payback less than 8 weeks. Last year, this well intervention program lifted production by 4,000 barrels a day. And the last bit is emissions. The focus on that, whether we can do the small things with substitution of diesel for gas, identification of fugitive emissions, metering to measure, and then targeting zero flaring by gas export. On the right, what does it cost to run the asset? Base OPEX was $23 last year. Life extension, which is the works to upgrade the assets, about $8 last year. Will go up a bit this year before dropping again. And then growth, that's directly linked to the $3 to $5 a barrel. If we keep at 20,000 barrels a day, we generate about $50 million per annum at $75 a barrel. So the next wedge is about optimizing the wells and the infrastructure. On the left, you can see the portfolio of wells, over 150 of which 42 are producing today. I've spoken about the light well interventions on the last slide and the paybacks there. Other opportunities that we're assessing, low-cost ones, gas lifts, which can add 75 to 150 barrels a day, 300,000 per activity, payback in 10 weeks. Slightly more expensive are heavy workovers, which add 500 to 700, and ESPs 400 to 500. Many opportunities here, payback of the lower ones, 2 to 3 years. So what we believe is the ongoing optimization can deliver over 5,000 barrels a day, which takes us into the mid 20,000 barrels on this asset. So the third wedge is infill drilling, and the opportunity is clear here. The last infill drilling was in 2010, so over 10 years since the last infill. Over 20 opportunities identified across the 9 fields in production, with initial drilling planned for 26, 27. We've just modelled 4 infill wells in this program, but our experience of other assets up and down West Africa could see this be multiple phases. What could this deliver? Well, 500 to 2,000 barrels a day, all economic at present oil prices. I think the key thing about this asset is it's almost unique in terms of the scale and the level of activity. It's very unusual to have anything of this scale with this level or low level of infill. The final wedge is development of satellite discoveries. So with the fiscal terms enhanced on Punja, it improves the economics on some of that DA. We've got the existing infrastructure, or we can fast track production with small production templates. 500 million barrels a day is identified here. 300 million barrels of oil in place in 305A, and 200 million barrels in Buffalo Norte, sitting in 305. If you recall from the first slide, we have 30 million barrels of 2C against that. That's a recovery factor of less than 10%, and we've got nothing booked for Buffalo Norte. Analogues might suggest 30 to 40% recovery factor as we get round to analysing and creating development plans for this. Gas 101 is one production example of this. Early production cash flow we've had for about a year, as well as building reservoir understanding. I think the other key thing here is these discoveries also unlock gas export which will be key to developing higher GOR, gas oil ratio reservoirs. And gas export is the key element that allows us to reduce routine flaring to close to zero. And you can see on the top of the map the import pipeline. So these discoveries have the capability to deliver over 10,000 barrels a day, but it's about value over volume and capex intensity to be key to phasing these investments. So summarising up and deliver it, how we're going to deliver material organic growth. Key messages here is that on our entry into the asset, we have now acquired 30%. With the three key main partners, we've got partner alignment, so there's no drag on budget, and alignment on maximising the value with the production. At the beginning, I spoke about a 2P of 108 million barrels, with the potential to over double to 250 million. And hopefully you can understand the potential and scale of the asset now. On the satellite discoveries, these are material in scale. Not many places you have 500 million barrels of oil in place adjacent to existing infrastructure, and they're not booked yet. And the opportunity here is to maintain reserve replacement like we achieved in first half of 2023, while we also perform reducing emissions. So that talks about 305 and 305A. I've included one slide on the onshore Kwanza, since these are acreage that we're in the final stages of initialising, as announced by ANPG. And the onshore basin, we picked up 2 licenses in the last round. It's an underexplored basin, potentially with hidden value, a bit like Congo, where we've been involved in the past, or Gabon. The licenses here, COM 15 and 19, they've been dormant for 40 years. Modern technologies like FTG, which is gradiometry, or 2D seismic, have yet to be deployed. Wells with oil shows on the licenses, demonstrating that there's an active petroleum system. And these are really snuggle exploration adjacent to legacy fields. So they're modest inside, potentially, but in terms of getting them to market, there's great infrastructure here. Tarmac roads, an hour and a half to Luanda, that you could truck to a local refinery. We saw an opportunity to partner with local companies and deploy our experience to help Angola. And there may be other opportunities onshore. So that I'll hand back. I've talked about the asset and its potential, and hand back to Paul.
Thank you, Ian. I just want to kind of close out on a few slides and look at, how does AFENTRA grow from this point forward? I think Ian's highlighted the very significant potential of Block 305 and 305A assets. As Ian's highlighted, we believe over the medium term, reserves could double and production will increase significantly. So we have core organic growth within those assets to look forward to creating value from. The second is in Angola. We've tried to kind of frame Angola, where Angola is at the moment, and the massive opportunity set. As we've highlighted, Angola is a very significant oil province with material potential, given the stage of maturity and the dominance of the IOCs. We believe our first mover advantage will deliver more opportunities within Angola. And whilst it appears our focus to date has only been on Angola, we have screened many opportunities outside Angola. And when we find the right value opportunity, we will diversify beyond Angola. So we see 3 key avenues for growth of AFENTRA in the medium term. So a few takeaways. We believe the value and growth proposition for AFENTRA. We've assembled a portfolio of assets with very significant upside and have alignment with our partners to pursue this value. Despite having just completed 3 transactions, our balance sheet is strong and supported by significant cash flow, which Ian has shown is very sustainable and should grow over time. And we're well positioned to capture more opportunities in Angola and beyond to continue to deliver value-driven growth. So with that, I'll hand over and see if we have any questions.
Perfect. Paul, Ian, Anastasia, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. Just while the company take a few moments to review the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions, both pre-submitted and throughout today's live presentation. And Ben, at this point, if I could just hand over to you to chair the Q&A, that'd be great, and I'll pick up from you at the end.
Thank you very much. Just to say at the start that we've had quite a few duplications of questions, and some of them are already addressed by through the presentation. So if I don't ask them, that's the reason why. First one, when do you anticipate the next acquisition to be announced?
Thanks, Ben. I don't think we'd put a time frame on it. I think we just reiterate the point that we continually screen opportunities, both inside Angola and outside Angola. We review these opportunities in line with our strategic criteria, and we strongly believe that more M&A opportunities and inorganic growth will come, but very difficult to put a time frame on it.
Okay, thank you, Paul. In an update last year, you mentioned that you're looking to build a company of tens of thousands of barrels of production per day. Is there a time scale on that, and is that still the plan?
Yeah, I mean, I think with the completion of the first 3 deals, we now have a strong operational and financial platform in which to pursue our greater ambition. So I think we're in a stronger position today to achieve what I mentioned at that time than we did a year or 2 ago. So yeah, very much still our plan to grow the company to a material oil and gas African-focused independent.
And a question here on shareholder returns. Is there a strategy or policy with regards to dividends and any time frame on that?
Yeah, again, I think we're very much in growth mode. I think if we look at the value creation that we've achieved for our shareholders, I think the monies that we had have been well invested. The cash flow and balance sheet, I think, will continue to be used to try and deliver strong growth performance. However, we have an eye on shareholder returns in the future. Therefore, as we construct our portfolio of assets, we'll be looking for assets that will provide cash flow generation so that we can service shareholder returns when the time's right.
Great. Got a question for Ian here. On average, roughly how long do you believe downtime will be for the biannual shutdowns, and how long will it take to ramp up back to full production?
Yeah, look, I mean, the planned shutdown is scheduled for about 3 weeks. That's what we've got in the budget at the moment, which is a normal for an asset of this age. There's a lot of planning that's been going on for the last 6 months. And in terms of ramp up, it all depends. I mean, it could be a couple of days to a week.
Thank you, Ian. Do you expect funding of future transactions to be of a similar structure to those closed to date?
Look, as we demonstrated today, we've been quite creative with sculpting the deals such that the ultimate shareholder value is achieved. So far, the deals have been done on a 75-25 debt to equity ratio. We continue to believe that the market is within the same ratios today as it was 3 years ago. So that's the framework. We'll ultimately work to achieve the best outcome of each deal that we review. Our criteria is very stringent. We're not going to deviate from the criteria we have, but generally speaking, we will aim to achieve the outcome and replicate the success that we have achieved.
Great. And as I said, you gave a lot of detail on hedging, but we've got some follow-on questions here. Given AFENTRA are now fully completed on the 30%, what quantities can you hedge? And does the irregular lifting schedule impact on the hedging delivery date?
Yes. So with regards to hedging, as we covered in our slides, we have a board-adopted policy, which generally guides us towards 50 to 70% of liftings to be hedged for the subsequent 12 months and 30 to 50% of liftings in the following 12 months. So far, we have purchased puts for the February and the June lifting. And the market right now has enough flexibility in depth to allow for the next 2 to 3 years of hedging to be placed. We will continue to update the market as we execute those hedges. And again, as I said, so far, the June has been hedged with an $80 put.
And just on that, had a question on how many dollars per barrel does the put cost, and if put bought at $80, above what level does AFENTRA begin to benefit again?
Sure. So with regards to pricing, obviously that fluctuates. We have paid $1 for the June puts. So effectively that allows us to realize all the upside from $80 upwards. We have no limitation on that.
Great. Got questions on CapEx, OpEx. What's the expected CapEx and OpEx per barrel during 2024? And are the operated cash calls for such CapEx and OpEx spread evenly across the year?
Okay, well, the second one I'll pass over to Anastasia, but the first one, in terms of the OpEx, in 23, it's running at about $23 a barrel, and we'd expect it to be pretty much flat in 24. As we look at the life extension works, we said $8 a barrel in 23, and that will be slightly higher in 24 and 25, probably $4 to $6 a barrel, depending on what gets accomplished, and then we'll go down. The growth costs are $3 in 23. They'll go up slightly as we deliver more work, probably in the 4 to 5 range in 24. Over the next few years, what we'd expect to see is the life extension costs come down, and then we start looking at increases in investment from a perspective of growth, so infill drilling, etc., as we come into sort of 26, 27.
So with regards to timing, the cash calls are sent on a sometimes 2 months, sometimes every 3 months basis, so quarterly basis usually. For planning purposes, we just make life simple for ourselves. So we just take the annual anticipated operational and cost and CapEx budget, and we divide it by 12. So our monthly run rate is about 8 to 9 million. And that's what we use for planning purposes. The actual cash call comes in, as I said, every 2 to 3 months. And we have a working capital facility, which we discussed earlier, to help us bridge in case there are any specific needs around those cash calls. We can always cover them from the working capital facility.
Great. Question for you in here on the satellite developments. What's the most likely next development? Kako Gazella, the oil field, or the gas-based Punja?
Yeah, I mean, it's a good question. We've got a number of development opportunities across 305 and 305A. And in the presentation, I made reference to about 500 million barrels of oil in place. What we're looking at is we're reviewing everything from a value, volume, CapEx intensity, and also gas management perspective. So the higher GOR discoveries, this would be Punja and Buffalo North. We'd need to make sure we've got a gas export solution to handle that, since we don't want to flare those. From a perspective of Kako Gazella, well, Gas 101 has been producing now for a year, and we've got valuable information from the downhole gauges that allows us to determine what would be the connected STOIT and whether a follow-up well could be drilled. Follow-up well on Gas 101 or to 101 could be drilled from an existing platform. That's the great thing of what we're working on. We could drill some of these discoveries from existing platforms like Buffalo North, while Punja may be its own small little platform.
Okay, and whilst we're on the assets, a follow-on one for you, Ian. With so many opportunities with regards to infill drilling, why wait until 2026, 27 to start going after them?
Yeah, that's a good question. However, we've also got a lot of low-hanging fruit in terms of the assets itself. If we look at the LWIs, which are coming in at less than 500,000, and you can have payback of those in 8 to 10 weeks. We're working through those. There's a lot of catch up to be done on those, and then lower cost opportunities while we study the right wells to be drilled. It's about value over volume and balancing that with capex intensity, as well as the gas oil ratio as well, to bring them on.
Okay. And with regards to the Q3 shutdown, what's the estimated time frame of that, and can lifting still occur during the shutdown?
On the timing, said it's Q3, about September timeline, and lifting.
No liftings.
Okay. And roughly what's the duration of the shutdown?
It's estimated at the moment 3 weeks.
Okay, great. Are there plans to develop Karma, Nunce, and Crisomo? And would they be part of a new block, or do they fall into 305?
They would form part of a new block. They're outside of block 305 and 305A at the moment.
Okay. Beyond Angola, you obviously referenced it in the presentation, Paul. I mean, are there particular countries of interest with regards to the opportunity to acquire mid to later life assets?
I don't think anything's really changed from inception, where we really said our focus is on production development assets, geographically Africa, sub-Saharan Africa mainly. And, we have good networks, relationships and knowledge up and down most countries in West Africa. So really we screen assets and opportunities in any of the countries in West Africa. So no, obviously Angola now is core to our future. And again, we'll anticipate that we'll enter another country at some point, but no particular favourites at the moment.
Okay, and whilst we're on the M&A, how competitive is the West African M&A landscape currently?
Yeah, I think it varies. I mean, clearly what you've seen us do in Angola is there was a competitive element to the Sonangol deal, but then we were creative, or the team were creative in thinking about the asset, and we did 2 1-on-1 deals that were non-competitive. So really the idea is to try and go and create deals rather than just go to auctions. We do attend data rooms where we go and look at assets that people put up for sale and decide to carry out an auction. But again, we also try to be very creative to look at opportunities and approach people on a very proactive basis as well.
With regards to the funding, are you confident you can deliver accretive acquisitions when the cost of debt is over 12%?
I think yes is the answer. Our current RBL is priced at around 13%, just a little over 13%. So 12% is absolutely, for us, would be a great outcome if we could achieve a 12% debt cost of capital. And we do believe that deals can be done at those levels.
Okay, great. Ian, one for you here on the onshore. It says FTG reference as a technique for the onshore basins, and believe that Tullow used this to discover the oil in the Lokochar basin in Kenya. Is that correct?
Yeah, I mean, look, the team has quite a lot of experience of using this in Africa. We pioneered it actually in 2008, 2009 in Uganda, and then we deployed it in Kenya and Ethiopia with the Lokochar exploration. And then we also used it in Zambia and Cote d'Ivoire. So we know how to use it, and deploying it early because we can use it to I would call forensically locate the 2D seismic rather than put the seismic in the wrong place. So yes, we've got quite a lot of experience of using it.
And a question here on the oil in place figure you referenced. Is the 200 million barrel oil in place on COM 15 and 19, is that on a single field or in total of the block?
The 200 million barrel oil in place is a field that is in a block called COM 4, the Kingela Norte field that was produced through to I think the late 90s. So that is the oil in place number for that field in the onshore Kwanza.
Okay, bit of a dual question here with regards to M&A. Can you just reiterate the sort of the key criteria that you're looking for, and is the intention still for AFENTRA to become an operator?
Yeah, so again, we've been clear that we're happy to be an operator. The team have got a lot of skills operating onshore, shallow water and deep water. So there's plenty of capability there to operate. We're happy also to be a non-operator where we have good alignment with the operator and where we're not just a financial partner, we can actually be an active non-operating partner. And I think the alignment between ourselves, Sonangol and M&P has shown that and how that works. I think it's working very, very well there. So happy in either case.
Regards to future financing, obviously you've delivered these 3 deals without any equity dilution. Is dilution off the table, or will that be considered if the right deal comes along?
I think we've always said, we had a balance sheet. One of the things that attracted us to the starting point was acquiring that early balance sheet. That's proven to be the right decision because it allowed us to complete these 3 deals without coming back to the market. I think that's been quite fundamental to the share price appreciation over the last 3 years. We look at incremental deals. The point Anastasia has made is our balance sheet is back in good shape despite having just completed a deal. So I think for smaller deals, we can certainly look at doing them from the balance sheet. We've got plenty of access to debt, so that's not a problem. But we do screen bigger deals. And when we assess a bigger deal, we not only think about the asset, the value we can create from the asset, but if we were to raise some equity, how is that likely to impact the overall value equation? And we take that on account. So, and I think our shareholders have indicated to us that they're generally patient people, and they're happy for us to kind of go steady and incremental if that means we're not having to come back to the market. Yeah.
And on the same theme, had a question about minimum size of assets that you screen. Has this changed following the closure of the first 3 deals, given the legal costs and time it takes to close deals?
We've looked at small assets. I can think of one where we got very close. It was a couple of thousand barrels a day. It's all about the value. I mean, even an asset for 1,500 barrels a day, if we can do it off balance sheet, we don't need to raise any equity. We can access debt. And if we think there's value to be generated, we pursue it. And one of the big advantages, I think Anastasia mentioned, is that most of the work is done in-house. So we have the legal, commercial, financing capacity and the technical capacity in-house, although we're only a small team, to execute these deals. So the actual cost of executing the deals is relatively modest.
Okay. You already mentioned the approach with regards to dividends. Got another question here that with the cash flows and the discount to NAV, might it be worthwhile to keep the option of buybacks on the table, or what's the general approach to buybacks?
Well, I think the board, I think as a company, we sat with the board and we're clear we're still very much in growth mode, and that's what we signaled to our existing shareholders. And when we meet with new shareholders, we're very clear that we're still very much in growth mode, and we think we can really deliver significant value through growth. As a board, we will always sit down and review what are the best options and what are the best uses of cash.
Great. With AFENTRA moving away from a small cap company, how do you plan on marketing the company to institutional investors and funds, both in UK and overseas?
We've had an active kind of marketing program from day one. We've always been out. We talked to many potential investors, small and large. We spent quite a bit of time. Obviously, we're talking to investors who are going into the market and have been buying the shares, given the performance today. But we spend a lot of time talking to investors who know the team, who recognise that AFENTRA maybe for that investor is too small in terms of market cap or some threshold for them at the moment. But we still spend time because we've always been very clear our aspiration is to grow to a much larger independent, and it's better to continue those relationships through the journey. And at some point, and we've seen it already, we've seen it with certain investors we've spoken to, when we were $50-80 million, they wouldn't invest. And now they've been able to invest as the market cap has gone through, say, $150 million threshold. So it's about an ongoing relationship and building those relationships and trust with a whole myriad of scale of investors.
Great. Great. A final one here, and it's not actually a question, it's a statement, and I promise you this isn't a plant. Someone said, just to thank you to the board and management for their honesty in keeping their shareholders updated. Long may it continue. So with that, I'll hand back to Paul for some closing comments. And if we didn't address any of your questions during the Q&A, please just send them into the info email, and we'll endeavour to get back to you.
Thanks, Ben. I do appreciate the last comment, actually, because one of the things we have really tried to do throughout the 3-year journey is be open, transparent, and communicate as best we can. So we're definitely committed to try and to continue that over the coming years. I think just to wrap up, I think I'd say a few things. One, we assembled a strong team back in 2021. We set out a clear vision and a strategy and a plan. And I think what we've done is we've executed against that plan, and we've delivered what we said we would deliver. We endeavoured to deliver shareholder value, which I believe we have. And we certainly intend to continue to deliver value-driven growth for our shareholders. So with that, I'll thank everyone again for taking the time out to join us this morning. And as Ben says, any follow-up, please just communicate with us.
Perfect, Paul, Ian, Anastasia, Ben, thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of AFENTRA PLC, we'd like to thank you for attending today's presentation, and good morning to you all.